Stretching a $550,000 mortgage from 25 to 40 years can cost you $100,000 to $150,000 in extra interest, and the monthly payment might only drop $150. That's the trade-off Canada's new mortgage rules quietly put in front of you. I read the fine print so you don't have to, and this one is buried in a policy almost nobody actually reads. Millions of Canadian homeowners will hit this exact decision at renewal, or when they buy, offered a longer amortization that feels like relief. Across all of them, that combined choice adds up to billions in extra interest. Today, I'll show you 3 moves. Check your real cost, stress test your renewal, and redirect the saved payment. Here's the number that started this. As of August 1st, 2024, insured first-time buyers of new builds can amortize over 30 years instead of 25, according to Department of Finance budget commentary reported by RateHub. But here's the part nobody tells you. Those 5 extra years don't just lower your payment, they quietly reroute tens of thousands of dollars into your bank's pocket. So here's the plan. 3 moves. Check your amortization and total cost, stress test your renewal before accepting any relief, and redirect the saved payment into investing. Each takes under 20 minutes and every tool is free. Let's break the mechanism down. Under federal rules, insured mortgages, those with less than 20% down, were historically capped at 25-year amortizations, according to RateHub's 2024 summary. From August 1st, 2024, first-time buyers of newly built homes can stretch that to 30 years. It sounds generous, and for your monthly cash flow it is, but a longer term means you're paying interest for more years, and that's where the cost hides. Now, the impact in dollars. Regulators describe this qualitatively, so I modeled it. Take a $500,000 mortgage at 5%. Over 25 years, total interest lands around $370,000. Over 30 years, it climbs to roughly $430,000. About $60,000 more, authors estimate. Just 5 extra years, $60,000 out of your pocket for a payment that barely moves. But there's a second layer, and it's sneakier. The updated Canadian Mortgage Charter, described in Educators Financial Group's 2024 budget summary, expects lenders to offer distressed borrowers permanent amortization extensions. No fees, no penalties. That sounds compassionate, but permanent is the dangerous word. Once your amortization is stretched, there's no built-in step-up to force you back, so temporary relief quietly becomes a lifetime cost. Here's why that matters at renewal. Say your 5-year term matures, rates have jumped to 6%, and the payment shock is real. So the lender offers to extend you from 25 to 35 or 40 years instead. Your payment eases, but total interest at 6% over 40 years can top $600,000 versus roughly $450,000 to $480,000 over 25, authors estimate. That's $120,000 to $150,000 in extra interest, just from saying yes. Here's the myth that traps people. Extending your amortization is harmless, it just lowers the payment. The fact? Federal policy literally calls it distress relief, and modeling on typical Canadian rates shows moving from 25 to 30 or 40 years adds $60,000 to $150,000 in interest, authors estimate. The lower payment is real, but so is the price tag. So let's put both costs side by side. The initial stretch from 25 to 30 years adds around $60,000 in modeled interest, and a distress-driven extension to 40 years at renewal adds up to $150,000 more, authors estimate. Combined, that's a lifetime cost pushing $100,000 to $150,000 in extra interest. Let me make this real with Sarah. She's 34, a mid-level project manager in Toronto earning $95,000 a year, and she just bought a newly built condo as a first-time buyer. Her insured mortgage is $550,000 on a 30-year amortization, with 31 years until she hopes to retire. Here's what Sarah found when she actually ran the numbers. Discovery 1. $70,000 to $90,000. That's the extra interest her 30-year term adds over a 25-year one, on her $550,000 at 5%, authors estimate. Her monthly payment is only $150 to $250 lower, and she'd assumed 30 years just made things affordable without really costing more. This is general information, not personal advice, but for Sarah the gap was tens of thousands. Discovery 2 comes at renewal, another $40,000 to $60,000. Suppose rates are higher and her lender offers to stretch her from 30 to 40 years under those mortgage charter expectations, described in Educators Financial's 2024 summary. Modeling that shift at 6% adds another $40,000 to $60,000 in cumulative interest, authors estimate. Accepting distress relief, she realizes, is like taking on a second 5-figure debt in interest alone. Discovery 3 is the one that stings most, $80,000 to $120,000 she never builds. If Sarah kept the shorter schedule and invested that $150,000 to $250,000 a month at 4 to 5% for 25 to 30 years, that could grow past $80,000 to $120,000, author's estimate, consistent with RBC and Morningstar's RRSP modeling. Extending doesn't just cost interest, it erases the wealth she could have built. Add it all up over Sarah's career, and the modeled gap is staggering. Around $150,000 in extra interest versus keeping a shorter term and avoiding long extensions, author's estimate. That's a $550,000 loan at 5%, renewing at 6%, stretched to 35 or 40 years with minimum payments only. So could this be you? Sign 1, you've never actually checked your amortization period. Sign 2, you don't know your total interest cost over the life of the loan. And sign 3, you'd happily take a lower payment at renewal without asking what it costs. If any of those ring true, the next 3 moves are exactly for you. Now for the fixes, and these genuinely protect real money. These 3 moves let you see the true cost you're carrying, avoid getting talked into a permanent extension at your weakest moment, and turn that monthly relief into wealth instead of interest. None of them require a financial planner, just 20 minutes and free tools. Move 1, check your amortization and total cost projection. Log into your lender's online banking, find the section labeled Mortgage Details or Amortization Schedule, and note your remaining years and current rate. Then use the built-in calculator to model total interest over your remaining term, and again for a term 5 to 10 years shorter, so you can see the real dollar difference. 3 quick steps. First, log in and open your amortization schedule. Second, write down your remaining amortization years and your rate. Third, model total interest at your current term versus 5 to 10 years shorter. What good looks like. An effective amortization near 25 years or less, unless you're in a genuine temporary crisis. Move 2, stress test your renewal before you accept any distress relief. Check the current posted 5-year fixed and variable rates from major Canadian lenders. Then use a mortgage calculator to estimate your payment if your rate rises 1 to 2 percentage points on your balance. Compare that stress-tested number to your budget, and to any amortization extension your lender proposes. Steps. 1. Look up posted fixed and variable rates. 2. Model your payment with a 1 to 2 point rate rise. 3. Compare that against the lifetime interest of any extension offered. What good looks like. You only extend when it's truly necessary, and only with a written plan to reverse it with extra payments later. Before I get to the last move, which is the most counterintuitive part of all this, and honestly the one that changed how I think about the whole trade-off. Stay with me, because it flips extending your amortization from a cost into a wealth-building decision. Move 3, redirect that saved payment into tax-advantaged investing. Confirm your RRSP room in CRA My Account, then treat the gap between your short and long amortization payment as a target monthly investment. Steps. 1. Confirm your RRSP contribution room in CRA My Account. 2. Calculate the short versus long amortization payment gap. 3. Automate that amount into an RRSP or TFSA. What good looks like. Staying under the 2025 RRSP cap of $32,490 per CRA. If breakdowns like this are useful, subscribe. The next one's already coming. Here's why this is urgent right now. From roughly 2012, the 25-year amortization cap became a standard feature of Canada's insured mortgage framework per rate hub. Then in 2024, the federal budget opened 30-year amortizations for insured new build first-time buyers as of August 1st. And through 2024 and 25, the mortgage charter updates pushed lenders toward permanent extensions for distressed borrowers, making long terms both easier to get and much harder to undo. Once you've acted, verify it worked. You should see your exact remaining amortization confirmed in writing from your lender. Confirm your stress-tested renewal payment actually fits your budget. And if you automated your investing, check that the first deposit cleared into your RRSP or TFSA. Everything I've cited today comes from the Department of Finance budget commentary via Rate Hub, Educators Financial Group, and the Canada Revenue Agency on RRSP limits. All the links are below so you can verify the rules and run your own numbers. So today, you learned how extending your amortization quietly costs 6 figures, and the 3 moves that stop it cold. Next, I'm covering the mortgage renewal penalty most Canadians never see coming, the fee that can wipe out years of savings in a single signature. That renewal penalty catches thousands of homeowners completely off guard every year, and it's entirely avoidable once you know where to look. If you want to catch that breakdown, subscribe now so you don't miss it.